What do you think about this splitting Tether into a US compliant and offshore version? What do you think this means for Bitcoin?
Earlier this year, my venture firm, we put out this report on when everybody was talking about, okay, so banks are coming to Bitcoin. The Trump administration repealed this key regulation, SAB 121, and that makes it much easier for banks to now adopt digital assets in general. And we're like, what does that mean? How do we steelman that? We did a whole deep dive with the CTO of Silvergate going into, here's what bank adoption for Bitcoin looks like. And a huge part of that question has been stablecoins. So we spent a lot of time kind of thinking really prospectively about what it means when stablecoins are coming into the banking system and how Bitcoin's ultimately going to be tied in to that form of adoption. So Tether being, far and away the most dominant, the decisions that they're making today are setting the precedent for what's going to be happening over the next 5 to 10 years with whether other stablecoin issuers do, et cetera. And yeah, so I think one of the key ideas that we came to is that when the Genius Act was passed in August this summer, that set a pretty hard line in the sand for in the US, if you are issuing a stablecoin or if you're financial institution participating with stablecoins, then you need to be dealing with stablecoins that are following the Genius Act's compliance. And that the two primary things that it did was it said stablecoins can only use short duration government agency liabilities. So treasuries and other agency debt. Those are the only things that they can use as reserves. And they're not allowed to use anything else. And then the other key regulation that was put in place is that stablecoins are not allowed to pay interest on the stablecoin unless they have a US bank charter. And that was just like regulatory ring fencing to effectively allow banks to still remain competitive within the market. There's this letter that was produced by the Community Banking Association that was sent to the agency passing the Genius Act and saying, look, you guys can't allow stablecoins to be paying interest. Otherwise, we're not going to be able to compete. And the reason for that is there's so much intermediation that goes into the banking system from the point at which treasuries are created the point at which prime brokers buy them, and then the Federal Reserve recapitalizes that debt into reserves within the system, and then ultimately the commercial banks are leveraging those reserves at the Fed through master accounts to lend within the system and create more money. And then banks who don't have master accounts have to link up to a bank that does have a master account. So there's all these steps in that path to the creation of money, and it's highly inefficient. And all Bitcoiners know all the problems with this. What stablecoins did is they took debt from the government and immediately issued it into a form of money. And it just disintermediated all these different steps within our banking system. And that's what's really scaring banks right now. So with that context, Tether had to create a US compliant stablecoin, the USAF. And that was one of the key ideas that we were speculating on the report, saying what Tether does is going to be a big decision here. Are they going to bring international Tether fully into compliance? Are they going to create something domestically? Or are they just going to move completely offshore? And it looks like they're kind of splitting between two different products. So that's kind of created and delineated this line in the sand of there's probably going to be an onshore US denominated debt stablecoin market. And then there's going to be the rest of the world and whatever regulations exist within the rest of the world. So this offshore market's really interesting. And what we find, how this all relates to Bitcoin is that Tether today, 5% of the reserves that are backing Tether are in Bitcoin. And that's something that's going to exist in the offshore market. And now when we think about that, we think, well, how are stablecoins going to be competing over time? When we have a much more open and free market for competition of these, they're going to start competing and have been slightly competing on paying some degree of interest. It's not like an industry standard yet, but sooner or later, Tether is one of the most profitable companies in the world. And sooner or later, they're going to have to pass along that margin to the consumers that are using it. And when we start to see this international market of competition among stablecoins where they're paying out interest, the question becomes, what reserves are going to be the most competitive reserves for allowing you to pay interest in the safest manner and maintaining stability of the asset over time? And so we already have precedent where Tether's been doing this at a 5% reserve ratio in Bitcoin. And then you can tie this in with what Saylor has recently done with the stretch micro strategy, preferred equity, and having a fully collateralized, effectively, not like within the terms of banking, but nonetheless having taking the economics of Bitcoin and using that to pay a fixed interest rate on short duration, a short duration product that's effectively acting like a form of liability. That those economics are kind of like the proto version that we see that'll eventually emerge within the stablecoin market for reserves, where those that have an asset that is producing a greater amount of capital return over time are going to be in a more competitive position to pay more competitive rates of interest against those that do not have that in reserves. And that was one of our predictions in this report. We're just like, there's going to be a market of adoption of Bitcoin into the reserves of stable coins over time. And I think, it depends on the time horizon and, a ton of other variables, but we think that reserve ratio is going to start to expand gradually. That's going to bring the price of Bitcoin up. Bitcoin is going to become more stable. And we'll start to see it become easier and easier to have Bitcoin as a reserve as it becomes less volatile with scale. So that was kind of like the big idea that we were pulling out of a lot of this.
So like this whole idea of offshore tether and offshore tether reserving better purchasing power than onshore tether over time, how would that impact the global economy? That to me seems like the Eurodollar system on steroids.
Yeah. That's kind of an interesting way of putting it. It's like, it's comparable, right? You'd expect to see capital flight. People are going to want to find more productive forms of capital. They're going to want to offshore assets as they have, and they're going to want to find the best means of accessing that capital. And I think, you can make a strong argument that U.S. denominated stablecoin market's not going to be very competitive at an international level when they're forcing collateral to be these things. And like, I think probably an interesting point of like historical precedent for it would be when we think about the wildcat banking system within the U.S. And a lot of people will refer to that system as like the 19th century banking system in between the central bank that occurred and ended subsequent to the Federal Reserve being created. There was this, period of, I think, like 80-ish years when we had like effectively this wildcat banking system, and it was allowing banks to issue money off their own reserves. The definition of free banking is kind of that. Systems that were based on gold reserves where banks would issue their own notes and people would use these notes as money, and banks would compete in the market to have the best notes that people demand. The wildcat system wasn't very free though, and it's not a good example of free banking because the ability to do so was done on a state-by-state basis, and each state was issuing all these different laws that were constraining the free market of the system. And like, in order for a free banking system to actually work, in order for banks to properly regulate the market and to respond to free market incentives, you can't have a ton of various statewide influence over the reserves you could be using. So they had things like bond collateral laws where states were forcing these wildcat banks to not use gold and to use their state debt in some way, shape, or form as a form of reserve in this system. And that fucked up the incentives of the system. And like, that was kind of like the main takeaway of the wildcat, is that like, when you intervene, like a free banking system, what's challenging with them is that they kind of have to exist in a vacuum. The second you start having these competitive dynamics where you are starting to influence the market incentives and control the reserves in the system, that's when banks go bankrupt for reasons that they shouldn't. And you start to get problems. So what I would expect is that if stablecoins become like, today they're kind of this narrow banking technology, but conceptually the idea of taking, a cryptographic signature, a token, and having it represent value backed by some form of reserve, then that conceptually can emerge as like in an offshore, more like free banking type market. It depends on, there's a million variables of how other governments are going to respond to a lot of this over time. But nonetheless, the U.S. is not going to be in a competitive position when they're going to be forcing U.S. debt as the only reserve asset. And then banks are going to be able to pay interest, and they're going to have these things called, in the U.S., they're going to, like, the new term for CBDCs is going to be tokenized reserve deposits. That's going to be like the new
Mhm.
wholesale CBDC, and then tokenized deposit. That's going to be like the new retail CBDC. And we already see that, right? Like JP Morgan launched a tokenized deposit, the tokenized deposit in like a beta program on the Base blockchain through Coinbase. And, it's like a stablecoin that's paying interest effectively.
Yeah. So you'll take your USAT, send it to Wells Fargo, and it'll go into an account that'll pay you interest.
Right. Yeah. And like, you can buy these things on basis tokens, and they're like actually paying out a degree of interest. I'm not sure what the mechanics are on the back end for how it's getting paid out. I'm assuming directly through some form of their stable coin. But yeah, I think the idea is that what that kind of means is that like Tether's probably going to get a bank license in the US, and then they'll probably be paying on the USAF token some form of interest, or they're going to issue like a new one that's effectively going to be like a money market account.
Yeah, I think tokenized money market fund.
The second order effect of this play is they want to run USAT on Tether's Hadron technology platform to bring real world assets to the Tether network, treasuries, bonds, things of this nature on top, and then. So I think but I want to know, do you think that this is they have brought in Bo Hines, so they have sort of regulatory capture. This is going to be more compliant with U.S. regulation, so they have a nice moat around compliance, and they have Anchorage. Who is it? Anchorage, who's going to be the issuer. So I wonder who the issuer is in the international Tether, and do you think that the USAT is going to outcompete Circle and become the number one stablecoin in the US?
That's an interesting question. Yeah. I don't have a strong opinion on it. I think that with all these things, these markets are very infant. So I think although they're still large, the market sizes are very large. And because they're still in their infancy, what people might perceive to be like an entrenchment or a network effect around some of the assets, we might be surprised that because we're so early that wasn't that significant of a network effect. Given, for all the points that you just described, I could definitely see Tether, overtaking Circle at some point.
What about in terms of social credit scores? Do you think one of these coins is more likely to have more draconian measures? That being the international USAT versus USDT versus USAT?
I think if we look at the behavior of some of them and, the alignment of the organizations, that you'd probably expect Circle to be, pushing more for that angle of compliance. But at the end of the day, I'd assume that they start to become pretty commoditized amongst each other about how they're all, structured in a similar manner.
I'm curious, did you see, or have you heard Luke Groman talk about the potential of in the next big recession that in order for the Eurodollar entities to start to receive FX swaps, that they get forced into dollar stablecoins?
Oh, that's interesting. No, I didn't.
Yeah, there was a really interesting take in regards to how it might force adoption in the next recession.
And yeah, go ahead.
No, I mean, it just hit me like a ton of bricks when he said that. I was like, holy smokes, because you could then start to view these stable coins as a runaround from the Fed, right? Is that like you're just going directly to companies and countries in need of an FX swap, and you're going directly straight from the treasury through a stable coin right to them. And I'm wondering, like, if you think that's just to put more pressure on the Fed to get more political control of the Fed, or do you think there's a real strategy there to try and eliminate the Fed long term?
I don't know about a strategy to eliminate the Fed long term, but I view it certainly as a new form of distribution that's circumventing it. So then the question kind of becomes, if we do start to see stable coins providing dollar liquidity outside of, the banking system towards, these international financial institutions, then that's something where you would probably see pressure come down on the stablecoin providers. Because the thing about like treasury auctions is that you have to meet all these requirements if you want to acquire treasuries at scale. Like there's like Treasury Direct that retail users with small amounts of money can go buy treasuries directly on. But if you want to do this in mass, then you need to be licensed within the US. So they are arm's length from being able to distribute that dollar liquidity, because they can choke off their access to treasuries if they don't like what they're doing and they want to force it back to the system.
Interesting.
This has been awesome. Thank you so much for coming on the show and breaking this down for us.
By the way,
yeah, of course,
if any of our listeners have not read Eric's most recent piece, go to X and download it. It's fire.
Thanks,
Eric,
guys.
tell them where to get it, buddy.
Yeah. Go to our website. It's epochvc.io. And if you go into our writings, you'll see it. It's kind of like the one at the top. It's the most recent, but it's a whole deep dive on everything you would possibly want to know about how banks are going to specifically be adopting Bitcoin. And then we get into a lot of the discussion around stablecoins that we were just talking about.